Hello dear students, so welcome back to our subject, so investment management. So today in this video we are going to discuss about the portfolio management and the meaning of the portfolio management, and then the objectives of the portfolio management. So what is portfolio management? A portfolio is a collection of financial assets and the investment tools that are held by an individual, a financial institution, or an investment firm. So usually portfolio management, all investors or company or individuals or financial institutions, everyone they will follow to rectify to stop the maximum loss. When you are going for investments, if you are investing the amount only in any one particular investment avenue, there are maximum chance for high profit or high loss. So to reduce the high loss and we can stop the loss, or we can make it less amount of the loss by going for the diversification process or different type of investments in different investment avenues. So instead of investing our money in one particular assets, we can go for the diversification process so that you can invest in multiple assets. Suppose if one asset gives you loss, the other assets it will give you at least average profit or high profit. So the maximum you can able to stop and you can incur only less loss. And when you are going for huge investments with a different type of investment avenues, so you can able to get more profits. So the art portfolio management is the art and science of making decision about investment mix and policy, matching investments to objective assets allocation for individuals and institutions, and balancing risk against performance. So portfolio management is a process of evaluating and managing investments based on an individual's objective in order to maximize the earnings with a given time frame. Now, what is the scope of portfolio management? So monitoring the performance of portfolio by incorporating the latest market conditions. So we can monitor the performance of the portfolio wherever we invested, what are the investment avenues we are following and invested the money, we can able to monitor and the performance of the portfolio, and identification of the investor's objective, constraints and preferences. So here easily we can able to identify what is the investor's objective, and based upon the investor objective we can constrain the portfolio management based upon the preference, and making an evaluation of portfolio income. So easily we can able to compare with the target and achievements with the past performance and whatever the investment avenues we followed for our investments, right? So we have the objective and we have the preference, we invested the money, so easily we can able to evaluate and we can identify whether we achieved the target or not. Now making a revision in the portfolio. So here you have the options. Once suppose if you are not able to achieve the target during the valuation session, easily we can able to identify, then you can go for a revision of your portfolio. So suppose if any of the investment avenues gives loss, or if it is not giving high profit, then you can change the investment methods, right? You can change your preference from one investment avenue to the other investment avenue which is giving the high profit, and implementation of the strategies in tune with investment objectives. So you can implement your strategy in tune with your investment objectives. So every investor having their own objectives. Based upon the objectives only, we are going for the investment. The objectives are different from one investor to the other investors. Now, what is the nature of portfolio management? So stable current return. So portfolio management will give you a stable current return and marketability. So easily you can able to market, or you can do the buy and sell in the market. Then for the tax planning. So here we have the tax planning method also when you're going for portfolio management. So if you're investing in the tax exemption categories of the investment instruments, so you will get the tax benefits. And then appreciation in the value of capital. So sometimes a few investments methods will give you appreciation in your capital. So when you are investing your money, it will give you appreciation for your capital amount, and then it's having the liquidity position. So easily you can able to convert as a cash at any point of time. Then safety of the investments. It will give you the safety for your investments. So these are the main category we are going to discuss about the objectives of portfolio management. So the fundamental objectives of portfolio management is to help select best investment options as per one's income, age, time, horizon, and risk appetite. So some of the core objectives of portfolio management are as follows. One is attaining long-term financial goal, then capital appreciation, maximizing returns on investment to improve the overall efficiency of the portfolio, risk optimization, allocating resources optimally, ensuring flexibility of portfolio, protecting earnings against market risk. So we will conclude these topics in this video, and in the next video, we will discuss the entire concept about the objectives of portfolio management. Thank you.